The money market's instruments come in a variety of forms. Some are interest-bearing and some are discounted. Some are negotiable securities and some are not. Some are actual physical securities, while others exist only in book entry form. In almost all cases, however, denominations are large. The money market is truly a wholesale market. Explore each instrument by clicking on them. Try a question when you're ready. Money market instruments pay interest in two ways. Interest-bearing instruments pay interest at maturity, and discounted instruments are sold at a discount. Click on an instrument if you'd like further explanation. Discounted instruments neither specify a rate of interest or make specified interest payments. Discounted instruments yield a return because they are issued or sold at less than face value, but can be redeemed for full face value at maturity. Although this change in value may seem more like a capital gain than interest, accountants and taxing authorities have agreed that discounts are in effect interest. The quote given for a discounted instrument is the discount rate, that is, the percentage of face value that must be subtracted from the face value to determine the price. Interest-bearing instruments are typically issued at face value and pay out a specified rate of interest on specific dates during the life of the instrument. U.S. bonds, for example, typically pay interest semi-annually. Interest-bearing money market instruments, such as certificates of deposit, typically pay all their interest at maturity, even if that maturity is greater than 6 months. The quote given for an interest-bearing money market instrument is typically the simple interest rate. A Treasury bill is a non-interest-bearing security sold at a discount to face value. It is issued by the U.S. Treasury in maturities of 3 months, 6 months, and 1 year, and is backed by the full faith and credit of the U.S. government. Interest is exempt from state and local taxes. Although Treasury bills were once issued as physical certificates, they are currently issued only in book entry form. Nevertheless, the contractual relationship is still the same as that reflected on this example. Over the years, Congress has set up a number of federal agencies created to help provide credit to certain sectors of the economy. The Government National Mortgage Association, for example, was set up to attract funds to the home mortgage market. Other agencies include the Banks for Cooperatives and the Federal Home Loan Banks. Although most of the securities these agencies issue are longer-term notes and bonds, they also issue short-term discount notes similar to Treasury bills. State and local governments actually issue two forms of securities important to the money market. The first is a traditional short-term note issued in anticipation of the receipt of some form of revenue. These notes carry names like Tax Anticipation Note or Bond Anticipation Note. Most of these are interest-bearing notes, but some are issued in discount form. The other important form is called Variable Rate Demand Bond, or VRDB. These bonds are actually long-term bonds issued for capital-raising purposes, but they carry a variable rate that may be reset as often as daily, and, most important, they carry a put feature that allows a holder to put the bond back to the issuer's marketing agent on the reset date. Here's a question. There are many long-term variable rate bonds other than VRDBs in the marketplace. Why are they not considered short-term instruments as VRDBs are? You are correct. Commercial paper is a short-term negotiable promissory note issued by a corporation. Most commercial paper is discounted, but some is interest-bearing. A banker's acceptance, or BA, is basically a special form of time draft. That is, a check payable on a specific date rather than on demand. More specifically, it is a time draft that has been accepted or guaranteed by a bank. BAs are usually created to help finance international trade transactions between parties that do not know each other. They are negotiable instruments and are sold at a discount. One of the most important markets in the money market is the market for eurodollars. That is, the market for dollar-denominated deposits on the books of either a bank outside the U.S. or an international banking facility in the U.S. Investigate any of the terms you're not familiar with by clicking on them, then try the question. The London branch of a U.S. bank would be considered a bank outside the U.S. So would the London office of a U.K. bank. The rising popularity of the eurodollar market caused a significant shift of funds from U.S. banks. To allow U.S. banks to recapture some of this business, the Fed created international banking facilities. These facilities are in many ways like Eurobanks, but as you can see, they operate under restrictions that severely limit their ability to fully participate in that market. Because of this, U.S. banks still look to their offshore branches as their primary doors to the eurodollar market. To understand what eurodollars are, one must first understand how U.S. dollar payments, other than those in currency, are made. All banks that are part of the U.S. banking system, including the U.S. branches of foreign banks, must maintain a reserve account at the Fed, as we show here. If CC Incorporated wishes to pay Big Corporation $10,000, CC's bank, Bank A, will simply instruct the Fed to transfer $10,000 to Big Corporation's bank, Bank B, for the benefit of Big Corporation. Press the Make Transfer button and watch this take place. If a bank outside the U.S. wishes to accept dollar deposits, it must open an account with a U.S. bank through which it can clear its dollar payments, just as UK Bank has done here. Just like any other client of the U.S. bank, it can then have U.S. dollars sent to it and can make U.S. dollar payments to others. Let's watch what happens if Big Corporation decides to deposit dollars with UK Bank. Use the Make Transfer button to make it happen. Dollars deposited with non-U.S. banks, like those deposited by Big Corporation, are outside the regulatory reach of the Fed and are referred to as Eurodollars. Big Corporation is now the owner of a Eurodollar deposit. And because UK Bank is not subject to Fed Reserve requirements, it can loan out all the dollars deposited with it without any need to retain reserves. Try this. You are correct. A repurchase agreement, or repo, is an agreement to sell a security and repurchase it at a future date. The repurchase price is set to equal the original sale price plus interest for the period of the repo. Repos are, in effect, collateralized loans. Repo transactions are also used as a means of borrowing securities to cover short sales. To see how, simply look at the transaction from the point of view of the party making the loan. From that perspective, the transaction is one in which securities are borrowed for a period of time. You are correct. Certificates of deposit, or CDs, are instruments evidencing ownership of a time deposit held at a bank. Some are negotiable and some are not, but all CDs pay interest at maturity. In this course, we focus on the large dollar CDs of the wholesale money market, often referred to as bank CDs, not on the smaller dollar thrift CDs of the retail market. The Fed funds market is the interbank market in which banks borrow reserves from or lend reserves to each other. Interest is paid at maturity. Non-banks do not have access to this market. Let's compare the instruments. Complete the table below to show how they differ with respect to interest payment, negotiability, and tax status. In the interest column, enter D for discounted or I for interest-bearing. In the negotiability and tax columns, enter Y for yes or N for no as appropriate. Try this one. Correct. A treasury bill is a discounted instrument.